So apparently the stock market is doomed and Trump is about to destroy everyone's pensions and life savings. Well, that's what the mainstream media is saying at least. But is this true? No. Okay, let's get that out of the way first and foremost. In today's video, I'm going to answer the question that I've had over and over and over again for the last 3 weeks here. Neil, should I sell out of the stock market now, or should I double down and buy the dip? Well, there's a number of things you need to understand about this current market volatility if you want to protect yourself and even profit. Yes, you can profit from this downturn. Firstly, why is this market decline happening? Well, it's the Trump factor. One of the biggest drivers of market volatility is Trump's trade policy or policies. His administration has imposed high tariffs on key trading partners, resulting in some explosive showdowns with other nations, which no doubt you've seen on TV recently. 1 minute there are tariffs about to be announced, and then suddenly he'll do a massive U-turn. So let me give you some context around this then. In February of 2025, a 10% tariff was placed on Canadian energy imports and a 25% tariff on other Canadian goods. And to say this made the Canadians a little bit upset would be an understatement. Trump hits Canada, Mexico, and China with tariffs all at the same time. Then in March of 2025, Canada retaliated with a 25% tariff on American imports and a surcharge on electricity exports to the US. This of course then caused even more escalation. Trump responded again by doubling tariffs on Canadian steel and aluminum, or aluminium if you're watching from the UK. So it wasn't 25%. It was now 50%. So what we had was this back and forth reversal then. After strong backlash from American manufacturers and supply chain disruptions, the US administration then announced a temporary suspension of the increased tariffs on Canadian steel. This somewhat unexpected policy shift caused further market swings as a lot of investors kind of scrambled to adjust their positions yet again. And what this did was highlighted the volatility created by unpredictable trade policies. And I'm sure most of you have already done this, but if you haven't already, could you please click the like button, subscribe if you're not already. Okay, let's get into a lot more of this then. So on the one hand, tariffs may seem like a good way to protect American businesses. And actually they are, or they will be when this all comes into play. However, in the short term, they often lead to a high degree of uncertainty via retaliatory tariffs from other nations, especially those who have been affected. So the stock market and investors react negatively to economic uncertainty, this is the key word here, leading to a number of sell-offs. And what happens when you get sell-offs? Well, they lead to even more sell-offs. This is because markets thrive on stability. People want their stocks to only go up in value and they don't like any risk. When businesses and investors can actually predict their costs, trade conditions, and government policies altogether, things are a lot more stable and you see better returns in the market. However, uncertainty disrupts this entire process. So what are we seeing right now? We're not just seeing uncertainty, we're seeing extreme uncertainty. So what other factors then cause market fluctuations, you may ask? Well, number one, geopolitical events. These are wars, military conflicts, rising global tensions. These can all shake investor confidence and drive volatility. Another one that we're seeing culminating at the same time is technological changes. So these are major innovations or disruptions like AI, artificial intelligence, can also drive entire sectors upwards or make others just completely obsolete. We also have corporate or government performance data or earnings. We have the reports, the budget deficits, growth forecasts. All of these things shape how investors perceive leadership effectiveness. Again, key word. Another one is trust in financial institutions. Scandals, fraud, mismanagement in banks or investor firms, these can all erode confidence in the financial system. Now, before I tell you about step 2 here, which is the big one, this is all about DOGE firing and how this affects things, I actually want to offer you a special opportunity today to take advantage of these heavy stock market drops and this volatility. So actually, if you look below this video, it's either in the description, pinned comment, you'll find a link to my own stock market investing program. And I mean, I made this program personally. I'm not selling someone else's program here. I spent 5 years putting this program together. So please check that out. You'll learn how to master the market, how to find cheap, excellent, undervalued stocks. And because I want you to benefit and join thousands of other students who have got all of these benefits, I'm actually going to make you a ridiculous offer. I'm going to knock 90% off the price of the program today. So please check that out. Spots will be limited on a first come, first serve basis. So if you're interested in that, I will see you on the inside. But with all that said, let's get back to DOGE, because this is a really, really important point. You've got to think all employees, whether they are efficient and effective in their work, or they are not, let's just say that politely, all of these people are receiving money every month via a paycheck. That paycheck equals household income. On the flip side then, household income is household expenditure. Now, if you cut tens of thousands of these jobs and you cut household income or expenditure, people won't be able to go out and spend as much in the economy as they were before, and this has a knock-on effect to company earnings, where those people were spending their money. Okay, so we clarified that point. What happens next? Lower company earnings reduce the stock price. And when this happens to enough companies all at the same time, and we haven't seen all this filter through yet, this kind of results in the markets reducing even further, because we're getting more sort of instability and shock reports. Because remember that companies don't just trade with the public, they also trade with one another as well. So this is another factor that is about to come into play. On top of all of this, these government employees would not only be spending their own money, but they were also spending the government's money. Remember these credit cards, thousands of them that have just been cancelled, or should I say more accurately, taxpayers' money. And already we've seen a massive decline in airline travel because these government employees are no longer flying. And this has an impact on company earnings too. This also leads us to a very big question now that everyone is asking. Is President Trump doing all of this on purpose to crash the markets? And if so, why would he want to do this? Well, you have to remember first and foremost that he is a businessman and he's a politician second, okay? So there's a growing theory suggesting that he may actually be orchestrating this market crash to force the Federal Reserve's hand. What does he want them to do, the claims say? Lower interest rates. Now, while this may sound crazy or extreme, there is some pretty solid logic behind it. Because remember that we have both fiscal and monetary policy that both affect the markets. I've gone over this lesson many times with you. So if we look at what's happening right now, the US government has a debt, okay, ready for this one, of $36.5 trillion. And those high interest rates make this debt increasingly expensive to service. In fact, the interest is so high and expensive right now that it costs more than the annual defense budget just to service this. So of course, when interest rates rise, the government must allocate even more revenue toward paying interest rather than funding programs or infrastructure projects, for example. So if the stock market crashes and recession fears start to mount, the Federal Reserve may be pressured or forced to cut interest rates to stabilize the economy. Lower interest rates would not only make borrowing cheaper for businesses and individuals, but it would also lead to a greater stimulation of the economy. So I really do believe there is a sense of urgency And that may be why he's being so heavy-handed, because over $9 trillion in debt is about to mature or refinance this year. And that's pretty big and significant. So if he can make the Fed lower rates, it means it will make a big impact on the interest the US has to pay. However, this strategy simply hasn't worked if it was the strategy in the first place. The latest Federal Reserve meeting, which was this month in March 2025, showed no decrease in interest rates despite growing recession fears. On top of this, we've started to see very strong charts on US production figures. What did we hear? Production was going to crash. We heard this. I said from the start, actually it's not. And with many analysts now stating that Trump's plan is already working, I actually have a different theory. I would be very cautious with this economic data we're seeing right now that's talking about production being up, because you've got to think what businesses have been preparing for. They've been preparing for these tariffs. So if you were that business, wouldn't you push production up now in order to get ready? I know I would. And as always, please remember, this is not financial advice. Firstly then, the people who invest when the market is down usually get the largest gains when the market recovers. And if you're looking to get involved, you've got a couple of options here. If you're a novice investor, you can simply buy into an index fund such as the S&P 500. It's about as simple as it gets, but you will need to do this through a brokerage or an online platform, right? If you haven't got a broker, you probably need to set up yourself on an online platform. In my program, I teach you all of this, by the way, and how to do it yourself so that you can save thousands on brokerage fees, which usually don't even beat the market anyway. So I'll just leave that there. Now, the other option, and this is what many of my students do, is to buy individual discounted stocks. And these are typically medium to large market cap stocks that pay out a very nice dividend and they're on a heavy discount. Now, it's a little more complex to that. It's wrapped around an index with individual picks, but I don't want to get into the details here. But again, I can show you all of that in my program very simply. And we even filter. I'll show you how to filter based on hundreds of different metrics, depending on what it is that you're looking for in your portfolio. We can even filter by sector or industry. I mean, whatever you want really. And you could focus on something like energy or utilities. And if you remember a month back, even in the newsletter, I hope you're on the newsletter, by the way, I talked about energy. I talked about how it would perform through this uncertainty. And if you look today, energy is one of the only sectors that is performing well, of course, as of the time of recording this video. The next thing is you've got to think long term, not short term. You get corrections of 10 to 20% drops fairly frequently. These do happen. You've just got to ride them out. Another thing you get are bear markets. You hear a lot. These are typically anywhere from 20 to 40% drops. Again, less frequent, but they're still fairly common. And then finally, the big one, these are crashes, which are 40% or more, and they're less frequent. So although rare, they are usually followed by enormous recoveries in the markets. Wink, wink, if you understand what I'm saying here. So finally then, regardless of the market, I always tell everybody dollar cost averaging is still your best bet. Whether in an up market or a down market, this strategy has been proven effective over many cycles, many decades. It has proven a strong result. Just remember then that market downturns are natural. They are healthy and they can be very profitable if you know what you're doing. But as always, prepare, research, and then execute. These are your three key things. So by following this strategy, as well as being diversified, you, like me, can grow your net worth no matter what the economy. And actually, for those of you who are best informed, this is where you can make very strong financial gains when the markets do recover. Thank you so much for watching, subscribing, and please remember to check out the stock market program below in the description, where you can join thousands of other students taking control of their financial future right now. Thank you so much, and I'll see you next time.